Good morning, everyone. This is Fader with another video. This, as I promised, is the P-shaped profile. In this video, I'll be covering my trading strategy when the previous day's profile is a P-shaped profile. So when I say this, I mean for example, on Thursday, if Wednesday's whole day profile, not the session profile, the whole day profile, is a P-shaped profile, I will apply this trading strategy that I am going to discuss in this video. So keep in mind, this can be used in daily or say session profiles, but I prefer to use the whole day's profile. So from Globex open till the normal trading hours close, that's the profile I'm talking about. And yeah, let's just get started into how I use the P-shape profile. So on the right of my presentation, you can see what I call a stereotypical P-shaped profile. On this chart, I've marked on the value area high as well as the value area low. We can see quite a clear, distinct distribution at the top with much smaller distributions at the bottom. You can see that I've written here, these profiles often form when the market rises quite rapidly and then consolidates. So we can see there's been quite a distinct lack of volume on these lower tails, and we have quite a big distribution at the top. This suggests that we rallied quite quickly into these levels and consolidated over here between the value area high and value area low. In a P-shaped profile, sellers often run into initiative buyers, and this often leads to what we perceive to be a short covering rally, as short sellers have to cover at higher and higher prices. And this continues obviously until we reach a state of balance, and this balance has been reached at the top, where we can see with this large distribution. In this chart, I have marked the value area low as well as three levels that I will discuss shortly. The levels being 3673.50, 3643, and 3615. As I said while we were on the introduction, keep in mind that these are daily profiles and are not at all session profiles that you may be accustomed to. You can probably see why I've marked these levels on the chart. 3673 is the bottom of the main distribution, or like the top of the P. 3643 is more of a smaller distribution, as well as 3615. Both of these are just below LVNs. You can see these LVNs over here and over here. And just above the bigger distributions, we can see this distribution and this distribution. This is going to be my specific playbook on how I play these type of profiles. You can use these for your own strategy development, as I discussed in the introduction video. These profiles are relatively simple in terms of how I trade them in the following day. So for example, this would be a profile from the Wednesday session, and I would apply these levels and trading strategy to the session that takes place on Thursday. My first go-to for this type of profile obviously is to long near the bottom of the distribution around the value area low. This is the area that is marked in the red solid line at 3673.50. My first play, hopefully, so let's say the market opens above 3700 into 3710, whatever. My first play obviously would be to try and long at 3673.50. This is just one play I would take. Risk would be around 3 to 5 points depending on the volatility on the day. I don't really like this setup as much as other setups that I will discuss in this video, largely because the expectancy that I get isn't as high and has quite a high rate of failure. So the second setup that I've written here, if we dip below this level, so if we dip below 3673, we get down to maybe, say we open at 3660 and we go back into 3673, retest it and then drop. That's my ideal setup for P-shaped profile days. So I would want to get short once we got below 3673. We want to retest it. Then I would want to get in with targets of 3643 and 3615. As I said earlier, I don't really like getting long on these days and much rather short below the main distribution. This is largely because, in my experience, the trades that I take while longing don't often really work out because the market tends to want to fill. There's usually singles here, and as it is a low volume area, the market tends to want to rotate through this to fix the error that it has created while while zipping through it, obviously. The singles itself are usually present at the bottom of their main distribution, and as market profilers would say, we want to correct these singles. And for me, as a volume area trader, as a volume profile trader, I'd want this to be filled and for this distribution to be traded into. My targets obviously on this trade would be this distribution at the bottom of the LVN, something I discussed prior in the Substack that I had created about the volume profile, how I like using low volume areas as a sort of take profit region, not as a trade themselves, and I like to take profit at the bottom of the low volume area once the support structure has been corrected. This is also true for 3615, which is at the bottom of a low volume area and above a main distribution. There's also another way I like to play these profiles. This is a slightly more riskier way of playing the profiles. So this is a slightly more risky way of playing the profiles, which is to long these smaller distributions at the bottom. So we can see there's a small distribution at 3643 and 3615. Compared to the larger distribution that is marked here, these are distinctly smaller, and thus they have not very little, but less volume traded than the larger distribution. And thus I wouldn't really want to long here, but nevertheless it is a good scalping opportunity. They are quite much more riskier than the trade I outlined previously, largely because we don't have the volume there, and the volume often doesn't tend to show up at these areas. These are, as I said, more riskier, and they historically haven't been a great trade for me, but nevertheless they are still a trade opportunity. The MAE at the maximum adverse excursion that I take on these trades is often quite high, and that's why I don't like taking them. I rather much prefer having a low MAE but a higher MFE potential. So as I discussed previously, this is how my risk on these trades and when I know I'm wrong. So my risk on most S&P 500 trades is around 3 to 5 points. This often depends on quite a lot of factors. For example, the volatility on the day, if we have any upcoming news events, is it regular trading hours, is it extended trading hours, what else has happened in the day, how other markets are behaving. It's quite a lot of, for example, seasonal, if there's seasonal events coming, for example, Christmas, New Year's, these days tend to have lower volume, and thus we can go through areas quite quickly with very little volume traded. So my risk is quite variable, but often it will always lie between the 3 and 5 point region. So this is largely because it helps my risk and reward, as I outlined in the introduction video, and having a higher risk to reward reduces the need for a higher win rate, and thus profitability is much easier. The trade example that is given in this video is one of the lower risk setups, so where I discuss the short once we get below the main P distribution of the HVN. This is one of the better setups that I have and that you can sort of strategize and develop around, largely because the risk is much less, because you're leaning on quite a heavy volume area, and furthermore, historically in my experience anyway, the trade has quite a lot of positive expectancy because we have quite a thin volume area below that tends to fill out very quickly, and so you won't be stuck in a trade often for much longer than 10, 15, maybe 20 minutes at most. As I said, I will be telling you how I play these, and as my setup, this setup in particular, I will try a maximum of 3 times. This will obviously include any stop outs I take, any rebids or reoffers. A rebid or reoffer is when, say we dip below the level, we go up, and then we see a bid on the tape, or supportive price action, and I would get in on that. The trade at the lower distributions that I discussed, which were the much more riskier trades, if you remember. Let's just show you one quickly. The trades that I would get long at 3643 or 3615 are much riskier, given the fact that the distributions in this size are much smaller, and we will be looking to fill out these distributions with some more volume being traded. So I would only try these once, and the same can be said for the very first trade I outlined, which was the long at this area. This is largely because these haven't been my greatest, historically speaking, and they tend to get run over very quickly as compared to the shorting once we get below the distribution. My initial take profits are at a minimum of 2.5R. R is the risk on the trade. So if my stop is 3 points, my first take profit will be at a minimum of 7.5 points. Then if say my stop is more than 5 points, or if it is 5 points, my take profit will be at the minimum of 12.5 points. And the rest of the take profits on these trade would be at the targets that I said previously. So for example, if I'm shorting 3673, my first take profit would be around 3660, 3620. My next, not 3620, 3665. My next take profit would be 3643. I would mostly be flat by here, so maybe I would have a 1/10 of my original position running for a target at 3615. Now I'm going to quickly discuss an example of this trade in action. I don't think I posted about this trade, but I may have. I'm not sure. But as I was making these slides I started working on in December, late December. There was a quite perfect example of this setup, and I could not hold off from including it. So a more detailed snapshot of that trade will be present. You can see it here. So basically, to give you some more context on that day, we had a very strong trend day, and some people were calling it a Santa rally. This took place on the 21st of December, and it led to quite a distinctly shaped profile, a P-shaped profile, presenting itself for the 22nd, which we'll be trading on. Just like the previous examples that I've given in this presentation, we had quite a major distribution, and we had quite a bit of smaller distributions at the bottom. We also had a small 4-point bounce from the upper distribution level, so we would essentially get stopped out, but the real money was made on the short side of the trade. So we dipped below the main distribution, held there, then proceeded to shed quite a lot of points with barely any bounces or relief rallies in between, and the only bounce being a smaller bounce at one of the lower distributions. So here is the trade example. Let's just start by quickly looking at the P-shaped profile. Here we have a quite distinct P-shaped profile. We have some consolidation at these lower levels, followed by a distinct rally and more consolidation to develop the P-shape. We can see we have one smaller distribution here and an LVN right here, and another smaller distribution here separated by a smaller, distinctly smaller LVN. This is the 21st, this is the 22nd on your right. We can see that we get a small bounce from the lower distribution here. This is the initial trade, so the initial trade would be to long at 3901. When we're longing here, we want to, as I said previously, this was my first trade. Something I don't prefer taking because at the bottom of the the HVN or the main distribution, but then again, it's still a trade regardless. So the first trade would be to long here on the 3901 level. We would take it, we would get a maximum of 4-5 points, probably get stopped out because look, it doesn't reach the minimum criteria for my take profit. Then once we hold below, this is a 15-minute chart, you probably can see this on the tape as well. We hold below the key level that I've identified, 3901. We test it, we get a slight fake out above. This wouldn't be enough to trigger our stop loss. We get short, we would ideally get short around here, maybe on the re-offer of this level, but there's essentially no need because the MAE is quite limited. There is like a slight issue with this trade that I would like to point out quickly, is that the take profit zone lies just around our first initial take profit. So we would be expecting, we would be expecting 18 points at most on this trade. So we wouldn't want to risk more than 3 points on this trade at all, because largely due to the fact that the take profits are quite narrow in terms of their expectancy, because we wouldn't expect, as you can see, we have quite a waterfall, but we wouldn't expect this when taking a trade, largely because our take profits would be located at 3883 and 3892. So as you can see, we hold below, we would get short here. As I said, there is a small bounce from this lower distribution, unless I want to say something like 7, it's around 7.5 points. I wouldn't have taken this, largely because I don't like taking these bounces as I outlined previously. They tend to be a bit more riskier than the main trade that I've stated here. There is no reaction at these lower distribution. The only distribution that really gives a reaction is obviously the main one, and then a smaller bounce from the lower one. We get no reaction at all from the lower distribution, and we waterfall quite a lot of points. That's the example. So the example, we can see on the previous slide that once we broke and held below the lower distribution, there was nothing stopping larger market participants pushing us through the lower volume tail of the profile. So the lower volume tail being this area, as compared to the distinctly P shape, or the top of the P shape, these areas tend to have quite little volume traded. We can see that the market participants pushed us through the lower volume tail of the profile, and this was almost a perfect example of a trade setup that would take profits situated at each of the lower distributions, here and here. You could have potentially not expected this fall because it was distinctly out of the profile or the range of the previous day. Here is another example. This from the 29th of December. This is the same exact setup that I've discussed in the previous slides. We have a P-shaped profile. In that profile, we have some smaller distributions. There's just a slight difference in terms of this profile, is that there is, and you can probably misinterpret the P shape. This is largely because within that P shape, there is a smaller distribution as well. You'll see what I mean when I go on the next slide. Just some context for the day. We had a very sharp rally with 2 separate consolidation periods. That's why we get the slightly unorthodox shape in the P. I refer to this profile as being more unorthodox due to the fact that it is a more subjective form of the P shape. We did have a small bounce from the bottom of the main distribution, but once we held below, there was an opportunity for a short, and we dropped quite rapidly. We did also manage to get smaller bounces from the lower distributions, another play type that I discussed in this presentation. However, once again, as I've said multiple times, the main trade of the day was a short, and the short took place once we get below the main distribution. So here is the volume profile of the chart of the day, of the 29th of December. Now you can probably see why I mean it's slightly unorthodox, because we have a larger P and then we have a smaller one here. It's slightly more unorthodox, more so than the previous example I showed, because in the previous example we have one sole distribution instead of this smaller distribution within the larger P shape. But nevertheless, this is still a P-shaped profile. There is a smaller distribution down here. There is one here as well, but I didn't mark it because it's sort of there is no real low volume node that separates this from the head of the P shape. So now that I've shown you why the profile itself is quite unorthodox, I want to talk about where the levels are. So within this, we have 2 scopes of thought. We can have a level at the top, at the bottom of the bigger distribution, or we can have the level at the bottom of the whole joint distribution, which is here. In this case, both of these examples would have worked out as a trade. You can see on the right, we do reject from the bottom of the first distribution, the one at the top, and then we also down here reject once we get below and hold below from the bottom of the whole distribution. Now you may ask, how would you choose which level to choose, which level to trade from, which level is going to give you the best RR. So in my opinion, the order that's going to give you the level, that's going to give you the best RR is the one down here. Why? Because it's the bottom of the whole distribution rather than just a singular distribution within this is what I consider to be the main one, but there is these sort of R join because there is no low volume area between them. So I would consider this to be in fact part of one distribution. Therefore, as I said in my playbook, that in the slides that I said previously, my short would be here, my short entry would be here. This would be the level I would be paying attention to. We can see now that I did also say my first play would be to long the bottom of the distribution. We can see this would play out, reject into the other level we were talking about, and then go below and hold. So now we have quite a bit of consolidation below the distribution. We go back up, retest it, we get a wick above, This is what we like to see. Barely any MEE. We then do that again and we dump quite nicely. So when we do dump eventually, we do test the top of the bottom distribution. And we can see that it does give quite a few bounces, serves as a nice pivot for the day because we can see a rejection here as well. But that's not the point. The point is, when trading, we want to get a few, maybe 2-3 good risk reward setups on the day and call it a day. So based on this profile type, my perfect setup, or how I would play this rather, is the short here. Why? Because it's the bottom of the whole distribution rather than a singular one. I would still have this as a level, but I would not focus on it as much as I would focus on this level. We could also play here, but I wouldn't, as I said previously, I would only play this once. I would play this twice, so we'd get one rejection and then we'd get another one, so we'd get 2 plays here. I wouldn't, at the end of this, realistically, I would have had enough points, so I really wouldn't play this at all. But for some of you who are more greedy, I should say, in terms of trading, you could probably reverse your position here, get long. You'd get quite a few points. I want to say 12, 13, 14 points. But then again, you don't really want to be greedy when trading. You want to find a few good risk reward setups that you can easily see on your chart, on your volume profile, and implement these. You really don't want to be looking for levels for 15, 20 minutes of a day when you're going to be executing for maybe 3, 4, 5 minutes. This is a very simple playbook, very simple example in terms of how I would use the P-shaped profile. So as I said, on the example, on the previous slide, we are able to see that there are 2 ways to distinguish the profile. One being the larger distribution and one being the smaller distribution. In this case, both of these worked, but for your future use, or for like a more consistent use of the profile or strategies or playbooks, to make them more objective rather than subjective, we really want to focus on the whole distribution. So we have a unique strategy that is applicable to all types of P-shapes rather than just this type. There we are. Yeah. So this is due to the subjectivity of the P-shaped profile in the previous slide, due to the distributions. Unlike the first profile example, where the main distribution was fairly well defined, in this example, there were 2 ways to define where you think the distribution ends. Based on this, there were 2 ways to trade the profile as I outlined just now. Both of these trades would have worked perfectly as well as the bounce from the lower distribution, which we can see there are quite a few bounces from the lower distribution. Both of these were very successful on very little MAE. Going off the previous example, this is another P-shaped profile. Unlike the previous examples, however, this is going to be more of a weekly profile rather than a daily profile. These type of profiles are very rare and infrequent in their presentation. This is largely because when we do have P-shaped profiles on a weekly time frame, they will correct themselves very quickly, so the tail will be filled out and we won't really be left with a P-shape. We most often get double distributions and quite a mixed profile. So like you might see a trend day profile, which is quite mixed with sort of mixed presentation of high volume nodes and low volume nodes due to consolidation periods. So when we do see a P-shaped profile, as I was saying, when we do get these profiles, they are quite rare. They do present really unorthodoxly because we usually get distinctly larger distributions at lower levels. This is because the volume traded at these lower levels is quite a lot higher than those at the daily profiles. So when these distributions do form at lower levels, they tend to be much larger, and we need to consider these with a greater emphasis than we consider the lower distributions in the daily profile. So some context for the week was that we had a small drop on Monday. This is for the FDAX market, the German index, followed by a rally on Tuesday, and then a consolidation period for the remainder of the week. Given that the lower distributions have much more volume traded in them, as I talked about in the daily profile, the lower levels should have a greater emphasis placed on them. And unlike the daily profile, I wouldn't try these only once. I would try these multiple times. As I was saying, this is just forward. I'm just going to talk about the slide on the next slide. We get multiple rejections from both the main distribution and the much smaller distributions. And the largest was a bounce from the significantly lower distribution. So as I said, the profile is going to be quite unorthodox. Let's just have a look at it. Here is the profile. We can see there is quite a large, distinctly shaped high volume node up here, followed by two smaller high volume nodes at these lower levels. This main high volume node is separated from the lower high volume nodes by a distinctly shaped low volume node, but these two have a very small, or I should say limited, low volume node separating them. And you can probably compare this to earlier in the video when I show you the smaller distributions on the other P-shaped profile. They are definitely not as big as these are, and they tend to be much more. These tend to be much more reliable in, for example, buying for a bounce, which was one of the trading strategies I discussed earlier. But a key issue with these profiles is on that your trades are going to tend up being longer. So for example, if I'm on a weekly chart or a weekly profile, my trade that I'm going to take from the weekly profile is often going to end up being 30, 40, 50, maybe extensive. It's going to be quite extensive, maybe a couple hours. But trades that I am taking on, say, a daily volume profile may just be scalps that last 5 to 6 minutes. So another issue with these profiles is that they are, as I said previously, quite infrequent. You won't see them nearly as much. So this is an example from, I think, June or July, and I don't think I've seen any P-shaped weekly profile since then. The imbalances tend to get corrected quite quickly, but the same logic applies in terms of the daily profile. So we have the P-shape, we have a low volume area which probably has some singles in it because of this distinct rally we can see. It's quite a rapid rally on the FTX market, probably caused by some news. It was quite a strong trend day, and the rest of the week was just consolidation. So as we know, we want this to fill out. We want this to fill out and get a bounce from down here. We can see that this obviously happens. The first trade idea obviously would be to try and long the bottom of the high volume node. This worked a couple of times, as you can see, quite a lot of points on offer. The shorts, on the other hand, did not work as well as it should have. The short did not work as well as it should have. This was largely because on these profiles, the time frame is quite a bit larger, so you would have got stopped out multiple times. So we can discount that. That would not have worked at all, or it wouldn't have been as effective. The real killer on this trade was this long of the bottom distribution. We can see we get two tests. The first test is quite a nice bounce, and the second test gives us a rally of, say, 300, 500 points. Unlike the daily profile, these distributions tend to be quite a bit more reliable. So as I said, I pointed out previously that I would only trade the daily distribution or the lower daily distribution once. In this case, I would trade it multiple times, maybe twice, maybe 3 times. But then again, the issue is you're really going to be presented with these on a weekly profile. You may find it more often on crude, but on equity markets, they are very infrequent because equity markets tend to be more rotational than crude in their nature. So you really don't want to be looking out for these because you're not going to see them as much. But when they do, you have a playbook and you will know how to play them. We can go over the example. In the previous slide, we can see that there is a P-shaped profile. However, this P-shaped profile can come off as a trend day profile or a mixed profile because we do have quite a bit larger low volume nodes down here. Some people may even consider this a double distribution profile and combine these two due to the fact that we have a very small low volume node gap between the two distributions at the bottom. This, as I said, we are also able to locate the smaller distributions, but in this case, they are relatively larger than those on the daily profile. So let's go back to the daily profile. We can see the daily profile here. In this daily profile, this high volume node has very little volume traded on it compared to this much larger node. But if we go forward onto the this one, the weekly one, we can see that we have much more volume traded, especially at this lower one down here. Based on this, we were able to see 2 to 3 trades presenting themselves in the following week with relatively good risk to reward and good expectancy, especially on the long trade. So with the examples out of the way, I'm just going to start wrapping up and telling you guys how you can improve and implement this into your trading. So now that we've seen how many, let's say 3 examples of how to trade these profiles, I've also given you a sort of step-by-step playbook on how to identify these setups. You want to go back on your charts, on your daily profile charts, not session profiles as I've said previously. You want to go on daily profile, volume profile charts you want to go back and find at least 5 to 6 examples of this profile in action. You want to note down the average MAE on the trade that you would have taken, hypothetical trades obviously, in the following day. So for example, you want to look at Tuesday's profile, and then you want to see how you would have hypothetically traded knowing what you know on Wednesday's profile. You want to note down the average MAE on the trade, the average expectancy on the trade, how many times it worked, how many times it didn't work, or if it worked at all. Once you've done this, you'll be able to establish your own trading strategy based on the P-shaped profile. A key issue I want you to remember is it's all hindsight until you actually implement it. So once you find out how or what the MAE and the other factors are that influence a trade, you want to go about looking for these examples on the profile and actually implementing them on the following day. So you don't want to always be in hindsight. You want to apply these to the future. You want to start off by paper trading these sort of just in your mind. Then you want to actually go on to testing them with smaller and smaller amounts. And once you've optimized your strategy, you want to move on and start trading this with real money and eventually upgrading and optimizing it as you go on. So as I said, let's just go through the strategies I discussed. It is possible to scalp the bottom edge of the distribution for some points on the long side, and the same can also be said for the lower and much smaller distributions that are present on the profile. That being said, the better play, in my opinion, especially on the daily profile, not so much on the weekly profile, is to short the bottom of the main distribution once we get below and hold there, with respective targets being the take profits at the lower distributions. So as I said, in the daily profile, the playbook for the first two examples was almost perfect, but for the weekly profile you have to be a bit different, largely because of the amount of volume trading being significantly higher than the daily profile. So with this is a video, hope you guys enjoyed. I'm going to do the next profile type I'm going to cover is the double distribution, and then after that we'll cover the remaining profile types. Thank you for listening. Fade us out.